Welcome to Subramani. I'm going to talk to you about some of the rules and observations in the market. Not everything belonging to me, some belonging to others. So the first one, there will always be mean reversion. Now people tend to believe that this time there will be no mean reversion, and please also understand that mean reversion happens to the market, to the fund, to the index, not to individual scripts. An individual share can go from 30 to 1300 and come back to 6 and just languish there. Right? Companies like Silverline have done that. Companies like Pateja Forging have done that. You don't think mean reversion means every share which you buy at whatever price will come back to that price. No, that mean reversion applies only to the indices. It is not applicable to simple single companies. Companies can get wiped out completely. Companies can stay at the bottom for a very long time and then completely disappear. Don't assume that every company will mean revert. Companies may not mean revert. Indices will always mean revert, right? So first observation number one, I would call. And then also, when you do an excess in one direction, suppose this is the base and you've done an excessive in one direction, don't think it will just move sideways and then slowly come down. It won't. It will come down like this and then go down, because excess in one direction will always mean excess in the reverse direction will happen for it to mean revert. Now that can happen to an index. It can happen to a single share also. If it is over bought by too many people and it has just gone up, then it may take you a very long time, maybe even a decade, to get back to that price. Look at something like Sun Pharma, good company, yes. Did it go to 1200? Yes. Did it come down from 1200 to 1150 or 1100 or things like that? Yes, it did, but the fall would have been very fast, right? So you never got a chance to do anything. So did it come down to 300? Yes, 300 is the price which I bought in March 2020. Of course, that's a wrong time to be considering, but yes, that steep a fall can happen, does happen, and therefore you get an opportunity to buy. Does it mean at 300 I knew it was a great buy? I knew it was a good company anyway. So in March 2020, one of the shares that I picked up was Sun Pharma, and I sold it at about 540 or 550, which I thought was a good price, and I got out. I also got in again at about 600 or 650, and now the price is around 850, 870, right? So these kind of things will happen, but to know whether a company is going sideways or falling down or is going to never come back, that is a very important skill needed when you're dealing with individual shares. If you're buying an index or if you're buying a portfolio, it is for the fund manager to worry about. But if you're buying individual stocks, don't just assume, oh, mean reversion will happen, this will happen. It may not happen, and it may not happen to that industry over a long period of time. So be careful about that. And whenever something happens in an excess, you will hear the orchestra of, oh, this time it is different, this time is not different, this is the same. But that orchestra will, the din that is created by that will, you will not be able to hear the very obvious voices of reason. So you will, when you see excess in any one particular industry, and that happens very, very regularly. Sometimes it is the pharma industry, sometimes it is the steel industry, sometimes it is the banking industry, the BFSI. So this excesses will happen, and excesses will not be corrected by a simple fall. It will be dramatically, the fall will be far more dramatic. I mean, look at all these things which tells you the air goes into a balloon much slowly, but it comes out very fast. Rome was not built in a day, but Hiroshima and Nagasaki were destroyed in a few minutes, few seconds, whatever you want to call it, right? So the destruction in your portfolio can be very fast. What you assiduously build up over 1000 rupee SIP and 5000 rupee SIP can just get wiped out like this. So you have to understand that quickly a wiping out can happen, and so therefore asset allocation, staying calm, all that is very useful. So if you're long-term equity player, 40 years, 50 years, you know that this will happen, and you know you will be helpless at that point in time. So then you don't worry too much about asset allocation. But for a new beginner, asset allocation is absolutely necessary, because if you don't asset allocate, you will panic. Nothing wrong with the market always behaves like that, but you will panic because you don't have asset allocation. So asset allocation between large cap, mid cap, small cap, between debt and equity, debt, equity, gold, real estate, whatever you are comfortable with should always be adhered to for your sake, not for the sake of the market. The market does what it wants to do. You have to do what is good for you and what you are comfortable. And remember, all this controlling of fear, controlling of greed, all that is easy to say, but long-term investing requires tremendous amount of resolve. That is the problem. You have to be willing to say, yes, I picked a good portfolio and I have the ability to sit for 10, 20, 30, 40, 50 years to create wealth. That is not easy. The long-term resolve is not easy. Everybody knows the theory, but when you go there, it's like if I'm standing in front of a biscuit jar or some sweets, you know that it is not good for you in the long run. All that you know, the theory is well known. Saraswati's job is well done. The question is, do you have somebody who will hold back your hand and saying, okay, don't eat this now, right? That wisdom has to dawn. So remember that long-term investing is easy, but that resolve to sit there tight over a falling market is not going to be very easy. So that will be your challenge. Markets can rise exponentially, and then you will feel that, oh yeah, the old economy is dead and nothing is happening, and this is what is going to happen. And then you have a Paytm happening, right? You have a Zomato happening. All these shares reach astronomical heights and then they just stagnate. No, they can fall and fall dramatically. So remember that those falls you will have to handle. If just imagine what would have happened if you were the last round funder of Zomato. Now the price is way below what you funded. If you bought Zomato, or forget Zomato, what about Paytm? If you had bought Paytm at its peak, or if you had bought Paytm even in an IPO, the chances are you're nursing wounds, and I have no clue when those wounds will heal. So be careful about being in the market. It is also true that the crescendo gets built up, so the retail investor comes in almost when the party is getting over, right? So there is when you're entering the party, you do not know that there is somebody at the back of the party puking with having had 8 pegs and 10 pegs or 12 pegs, whatever, right? So you need to remember the party is going on in the front thing, but at the back the party is already over. The smart people have had their drinks and they have left, and then you're left with, and still there is crowd coming into the party. These are the people who will be stuck at the party when the music stops, right? So the smart people have already left. These people who remain back will pay the price for it. So be careful when there is retail buying at its crescendo. It's a time that industry may not be in great shape. One good thing about Indian markets now, what I like, is the money is coming very, very steadily in the form of an SIP. So that is, I wouldn't say the retail is coming only when the markets are at its peak. They have come for a very long time, and but be very careful. Yesterday I heard somebody talking nonsense that last 10 years investments of the FIIs have been pulled out in 1 year. Completely wrong. Go and check your data. This is completely wrong. If they had done that, the market would have collapsed. The FIIs have pulled out, but they have not pulled out that much. Also remember, FIIs came in at a lower price and they're pulling out at a higher price. So obviously in quantum of stocks, if they bought 1 lakh Tata Steel, they're selling 1 lakh Tata Steel, but obviously the price has gone up. So don't compare with what came in and what is going out. Obviously there will be some profit booking or whatever. Some money has come in and a lot of money has gone out, but what has gone out may not be 10 years return, or the 10 years money came in 10 years and went out in 1 year. Completely wrong. That has not really happened. Fear, greed, everything is fine, but against that you have a long-term resolve. You say, oh, I'm going to be there for the long term. That's a fine, fantastic resolve. But fear can overpower it. Greed can overpower it. When somebody tells you, I think this is a good buy, chances are you will say, okay, let me just put 1 lakh into it, let me just put 5 lakhs into it. There is always that temptation for you to lose money. So you have to be careful about that, right? markets are strong when there is a huge participation, when there are a lot of people participating and lot of shares are going up. It means there is broad participation and everything is happening in one direction. But when you find the market getting narrower and narrower and the amount of money coming in is restricted and only the best of shares are up and all the others are weak, it means the participation is less. So the capitulation can happen. The good shares can also go down when a lot of people withdraw from the market. So be careful. Even if you're a long-term investor, these are good indicators that this is not a great time to be buying. At least when there is a market participation is not broad, that's a time when you should not be at least buying. Maybe you sit tight but don't buy, right? Bear markets have there are stages of a bull market. Similarly, there are stages of a bear market. First is a sharp fall. It falls, and there is this stupid concept that it has to fall 20% to be called a bear market. So 19.9 is not a bear market, but 20.1 is a bear market. This is nonsense. So when the market falls very steeply, you might be entering a bear phase. So once you enter the bear phase, then you will have a slow reflexive rebound, right? Small reflexive rebound. I'm using somebody else's words. I'll tell you why. And then there'll be a drawn out fundamental downtrend. So it could fall like this. It could go up like this. Some buying could happen, and then slowly the excesses would be withdrawn by the market going down even further. So the sharp fall, then some kind of sideways movement, or sometimes even up movement of people wanting to catch a falling knife or whatever you say, and then it could slowly come down when the fundamentals catch up. For example, if the market cap of all the pharma companies is equal to HDFC Bank, okay, then you realize that pharma is really not attracting money and banking is attracting money, right? So some of these things you understand, and then slowly the market cap of HDFC Bank will come down and the pharma companies will go up to such an extent that one day this market cap of Sun Pharma will be equal to the whole let's say infrastructure industry, right? Leave out maybe a Larsen and Toubro. So all these things can happen, and you know. But the problem is, largely you can know you're in a bubble only when the bubble is over. Okay, this was some general observations. Thank you very much.